what are the pros and cons? I can definitely see assisted living seems to have higher return, but I also feel like because there's more human touches and there's also high risk.
65 in 2040 is going to be 1 in 4 Americans, which is
Mhm.
crazy. 10,000 baby boomers retire daily until 2030. It's currently a $96.6 billion industry in senior living. By 2030, it'll be 140 billion. Be very careful on who you choose and their experience level and what their portfolio looks like, and also that they underwrite extremely conservatively. And those are all the factors that I look at. And then you also do your own due diligence as far as looking at the market.
Welcome to Senior Living Investment with Emily Bow. Today, I have great pleasure to have Megan Young to the show. Megan is a successful investor and entrepreneur with a passion to build value in the real estate industry. She is also the founder of Sky Capital, a firm specialized in multifamily and assisted living investments and private equity. She is also a highly sought after speaker and industry leader with insightful perspectives on real estate investment. Welcome to the show, Megan.
Thank you. Thank you for having me.
Can you tell us about your career path and what led you to focus on investing in multifamily and assisted living facilities?
Yeah, absolutely. So I started about 6 years ago. I guess I'm going to have like every story that most people do. I had a normal corporate job. I was working in sales and still doing very well, making 6 figures, but I knew I didn't want to have a boss. I wanted to have that freedom and to be able to do what I wanted. So I don't know how, but somehow someone led me to the book that I guess we've all read, Rich Dad Poor Dad. That kind of was like a mindset shift for me, that I didn't want to be an employee, that I definitely wanted to be an investor. And after that, I discovered Bigger Pockets podcast, which was absolutely like my school. For about a year, I listened to that just while I drove, because I used to just do business to business sales for optical. So I was driving, 4 or 5 hours a day. So I was really able to learn a lot. And from that, I started in small multifamily. And I started out with a fourplex. And I found that it's in Cleveland. So I wanted to start in a market that wasn't very expensive, where I could learn. And I was just able to network through Bigger Pockets platform, found an agent that was investor friendly. And that asset still today is doing absolutely amazing. Cash flows like crazy. And so I felt like I'd really done well. I did it actually while I was pregnant with my son, and I had a 2-year-old, and my husband's a pilot. So he was gone a lot. So I kind of proved myself. So he was like, okay, here's more money. You can do more. So then from there, I started buying some more multifamily. We actually bought something in Florida next, a duplex. And from there, I just kind of loved it and was like, okay, how do I do more? How do I scale? And so I started looking up apartments and how to invest in apartments. And from there, I discovered apartment syndication. So I went to my very first conference. It was a Brad Sumrock conference. And at the end, just like every real estate conference, they offer some sort of mastermind that they sell you to get into. And I was very, very new to apartment syndication, but somehow I met some great people and their sales team talked me into it. I later found out I shouldn't have even been in it. I was supposed to do a lot more training before I got into this mastermind, because it was for really like sophisticated, experienced investors. But nonetheless, I got to experience for the next year really just what it was. I got so much knowledge by getting to know all the operators that were within that mastermind that had been it for years, that owned thousands of units. I made some great relationships, and I decided to start out as an LP, limited investor, and kind of just see how it went. And so I invested in a deal in Tennessee, which, I'm still invested in that. They're usually 5-year terms. So I'm still waiting on that. And it went well. And then from there, obviously, interest rates changed overnight. And when I went to do more investments, I realized that the investment returns were just not like they were before, pre-COVID and everything else, or even after COVID, actually, just before the interest rates. So I started to look for a different asset class to invest in where I can get more cash on cash return and just better returns in general. So I came across assisted living. I met that operator through, again, just networking, going to conferences, and ended up actually being on the co-GP this time, with all of everything I'd learned for the last 2 years prior. I was like, okay, I know how to do this now. Now I'm going to jump in, be part of the co-GP and help other investors really invest passively, since I feel like it's something that's awesome. It's a lot easier than finding your own multifamily and dealing with management companies and everything else. And if you can get great returns, I feel like why not do both or do one if you're a busy professional, you can only do one. So I did that. And yeah, now I've discovered assisted living and the returns are just amazing because they're a business and real estate, which is significantly different than multifamily. Now I'm kind of all in with that, but I'm still looking at other investments, but I do love assisted living for investment purposes.
I see that your trajectory, you start from small multifamily,
Yeah.
then you get into apartment syndication, and because of the current macroeconomic environment, then you actually found another great asset class, which is assisted living. That's basically where you are, and you are focusing on helping people to invest passively. And as you who start with small multifamily, which is kind of manageable for some foreign investor, now doing these bigger deals, how would you see the difference if someone come to you and ask, should I go and put my money in a small multifamily, fourplex, duplex, or I should go like invest my money on an LP deal on assisted living or multifamily? Like, what kind of advice would you give to them?
And that's honestly like my first question always is, what are their investment goals? How much time do they have? And with that, you can kind of determine, right? If it's someone that wants to keep their full-time W-2, they don't want to be hands-on, they just want the return, they just want that mailbox money, then it's easy. Obviously, they're going to be a limited partner where they just put their money into an investment and collect their mailbox money, they collect their K1 and they're done, right? They're making money. Versus someone that wants to be more active, that wants to, they have good credit, they're able to put some money down and they want to acquire a fourplex and they have the capability to do that as far as money and time and everything else, then that's also a great route. That portfolio, you're obviously going to get the full appreciation on that. And those are always great investments. I mean, I feel like if people have the time, do both. It's hard to just do active investing for a lot of people because it does still require a lot of time and money. But if you can do both, do both. If you can only do one depending on your job, then obviously the limited partner thing can be awesome because on these assisted living facilities, they still are giving 10 to 12% cash on cash, which is a great return, even if you're active.
Speaking of assisted living facility, then compared to multifamily investment, what are the pros and cons? I can definitely see assisted living seems to have higher return, but I also feel like because there's more human touches and there's also high risk, then how do you evaluate this kind of risk compared to an investor's risk tolerance?
Honestly, I feel like with multifamily, you're going to have way less regulations. Like obviously with assisted living, you're operating a business. It's not just real estate. You're not just providing a place for someone to live. You're actually like taking care of people. You're providing medicine, you're providing meals. I mean, it's a whole different, completely different investment. However, as long as you research your operator and you know that they know what they're doing, that they're compliant with the state regulations, and they also have a full staff with there's nurses, there's care providers. And as long as they're following all the policies, regulations, et cetera, then that's something they take care of. So as a limited partner, you don't ever have to worry about that. That's not going to be risk. I mean, just like with multifamily, like you're not going to have any of the risk. That's going to be the general partner team. So that's kind of the beauty about being a limited investor is you don't have the risk. Versus if you even have your own active multifamily, you still have risk. Someone could fall on your property and sue you. You know what I mean? So that is a huge benefit in being a limited partner for sure.
I agree that being a limited partner is more a passive role, but it's good that you provide a service to the operator and making sure a deal is a solid deal. Otherwise, the risk for limited partner or passive investor, if they put the money in, they may not get the return as promised from the beginning.
My biggest thing that I like to look for is operators that have a track record. They also are vertically integrated, meaning that they're not relying on third-party management. They actually either do their management, they possibly have a construction company. I mean, with multifamily, I would still invest in multifamily, but it would only be with vertically integrated operators that have already a whole portfolio. If something did go wrong, it's like they have a portfolio to rely on. They could technically cross collateralize and they wouldn't necessarily have to do a capital call versus you're dealing with one syndicator, one multifamily, that's all they have, things go bad, then your capital's gone. Yes. Be very careful on who you choose and their experience level and what their portfolio looks like. And also that they underwrite extremely conservatively. And those are all the factors that I look at. And then you also do your own due diligence as far as looking at the markets. If it's multifamily, you want to make sure it's good job growth, that there's not too much multifamily in the area, that there's still demand for renters. And then for assisted living, you're going to want the aging population to be high in that area and not a lot of facilities. So you can look at occupancy rates, et cetera. There's a lot you can do, and you could just ask whoever you invest with as well to provide that for you, provide the track record, provide the market statistics. They're usually going to provide that in the investment deck as well. But if they don't, then that's a red flag, in my opinion.
I love it. Can you further elaborate on that? If I were passive investor and I come to you or an operator, what kind of questions should I ask them other than just reviewing the OEMs and stuff?
Yeah, I would ask, some of them will provide their track record and some won't. So you could ask for a list of REO, which is just real estate they own. So you can see stuff they've owned. You can also ask for, okay, on this past project, what were your projections? And then how are you a year later? So on my operators, the last investment that we did, we're already on year 4 of the pro forma ahead. So our NOI is already on year 4. So we're like doing absolutely incredible on that investment. And the investors are thrilled. And now we have another 2 facilities that we just got under contract that we're raising for because the first one's doing so well. And so now we have those investors that will be repeat investors because we have that track record. We proved to them, hey, we underwrote extremely conservative. We're way ahead schedule. We're doing amazing. And so now they feel more confident. So another thing that I like to tell investors to do is talk to passive investors that have invested with that group before. Like I have a Facebook group where I just invite passive investors to go on and talk about operators because you can learn a lot from being a limited partner on an investment. Like, do they communicate? How much are they communicating this with us? Are they saying what's good, what's bad, what's happening on that quarterly basis? Are we on part with what's going on with the projections, or are we falling short of that? Obviously, quarter by quarter, you can't judge everything. It's usually like an annual. But I think you can learn a lot by the communication and by just asking those kind of questions. I actually have a checklist too that I can send to you and you could provide for the listeners. And it actually is like a full-on checklist of like, ask this, ask this, ask this. Because I'll forget everything.
Can you please further elaborate in terms of how do you vet a potential deal and the operator before making an investment or before agreeing to be a co-GP on the team?
It's kind of all the same stuff we just talked about. I talked to as far as like vetting a sponsor, I talked to other co-GPs that had worked with them before to see how they worked. Did they follow what they said they were going to do with the business plans, with the deal? I look for extremely conservative underwriting, conservative debt, lots of buffers, exit strategies as far as if something goes wrong, how can we still make it up and not have to ever do a capital call? I feel like things like that. And then obviously just values, knowing that they have great values, that they have similar values to mine, that they're honest and trustworthy, and that I feel like I feel comfortable with them and know them, that I've had dinners with them, that I've spent days on business trips with them where I fully know them and trust them enough to invest my own money and invest my friends' money, my family's money, So we got to get personal. We got to really get to know each other. As far as the deal goes, it obviously has to be a good deal. It has to have a good cap rate. It has to be a discount of some sort. That's why we're buying it. And for us, we only buy in East Wisconsin with the group that I'm currently working with. So we're just expanding now. So we're using our same operations, our same management, and we're really just expanding now because our first facility has such a great track record and has a 5-star rating. We have a wait list for it in that area. We're actually just acquiring more facilities and using that same brand, which is called Serenity Villas. It's actually very popular in the area. They have t-shirts that people wear, and it's kind of like the high-end facility in the area. If you send your parents there, like it's known as a very great facility. I think reputation is also huge in an area. Like, do people know about your facility? Do they know your brand? Do they know, like, hey, when my mom's that age, I know I'm going to go to that facility because it has that brand. It has those good reviews and people talk about it and it's referred to people.
You mentioned exit strategies, but with assisted living facility, what kind of different exit strategy one can have?
Well, obviously selling is one. The nice thing about assisted living is you don't have to have as many because most of these deals are going to be a bridge debt to HUD. So essentially, we're going into HUD debt, which is the lowest rate you could possibly get, and it's fixed. It's the safest debt you could possibly have. If you conservatively underwrite the deal, and we underwrite it for that higher bridge debt for the first year and give ourselves a buffer on that, then once we transition to the HUD debt, the rate drops like 4 points. So it's like we're having like so much makeup in it. So I mean, the biggest exit strategy, I guess, would be selling, but there's a lot of ways that we would obviously increase NOI by adding marketing, by getting more private pay versus public pay because they pay a bit higher, and just having good relationships with not only our residents because they refer other people with the residents' kids, because that's typically who you're dealing with, and also hospitals nearby that would refer anyone that's senior that happens to need to go into assisted living. There's a lot of different ways that you can do that to just improve. I feel like multifamily, there's like a bit more, like you can recapitalize your debt, which is typically the reason why a lot of multifamily syndicators got in trouble is they underwrote everything to, increasing rent because that's what was happening for the last 2 years. And they were too leveraged. The LTV was way too high on these loans, and they were 3.25%, 4% loans. And then it went overnight to 7%, 8%, and they had bridge debt. So bridge debt is short. It's 3 years. Their plan was, hey, in 3 years, we're going to refinance. Your whole business plan is based on a refinance when you can't predict the future and you don't know what the interest rates are going to be in 3 years. That's not a good plan. It's unpredictable. And that's why you have so many multifamily syndicators that are doing capital calls, that are struggling, that are trying to renegotiate their debt with their lenders, and they're having to sell for a loss. And a lot of investors are losing their money. Or they were supposed to sell in year 5, and now they can't sell for year 8 because they just had to change everything and change their whole plan. I mean, that was a big learning curve for, I think, a lot of multifamily syndicators because I feel like it was this trendy thing where like everyone took a course, they went to a conference, and like the next week they were like syndicating a property. And it was like, okay, you know what I mean? I think like now investors are very weary of that. Like you definitely want the track record, you definitely want the portfolio that exists so that you can buffer any of those things in the future. But I think assisted living is a lot safer in that regard because you have the HUD debt, so that's not going to change on you. And in addition, you have a huge demand with just the number of baby boomers that are turning 75 in the next, let's see, 65 in 2040 is going to be 1 in 4 Americans, which is crazy. 10,000 baby boomers retired daily until 2030. It's currently a $96.6 billion industry in senior living. By 2030, it'll be 140 billion. I mean, those are insane numbers. So if you're looking at just the metrics of supply and demand in economics, this is a good sector to put your money in. Like it's not shrinking, it's only growing. So it's huge. There's going to be 1 million seniors that will need places to live by 2040. So
Yeah.
those are huge. I mean, and multifamily, of course, has its demand as well, but it's very market driven. You better make sure that that's a market where people are continuing to rent, and they're still going to have the demand for that as well. But I just think that this is almost like a national crisis that's going to come because there's not going to be enough housing, which means that the prices are going to continue to go up, and they're already pretty significant with an average of 35, 45 a month with just the basic service of having an assisted living rent, but then they add extra services, memory care, et cetera, that number could go up to as much as 8,000, sometimes 10,000 in some markets. So you're looking at amazing numbers as far as rent. And the other benefit that I love about assisted living is that it's a business and real estate. So as an investor, you're investing in two different things, like private equity to a certain extent and real estate. So you're still getting all the same benefits. You're getting the bonus depreciation, you're getting the forced depreciation once they sell, you're getting the K1s to offset your taxes. But then you're also getting all of the extra cash on cash from investing in a business. That's kind of why I fell in love with it, because I feel like, and I don't know if people know a lot about private equity, but private equity, the returns are way better typically because you're investing in businesses and they'll buy businesses that are not struggling, but they know that they can essentially grow their EBITDA to a specific amount. So the returns are actually like 16 to 30% cash on cash month one that you invest, which if you tell that to a real estate investor, they'll be blown away. But you also don't have the same safety as it being a tangible asset, right? And you don't have the same tax benefits. My advice to investors is always diversify. Do some multifamily, do some assisted living, do some whatever, mobile home parks. They have also great returns. Do some private equity, do a gas and oil fund. I mean, just diversify, because then something doesn't go right, your portfolio is not going to suffer. It's going to still be okay because one thing's going to lift it up.
I definitely agree. Like diversification is really important. And you actually touch on something I think will be good for any passive investor to know the deal as well. And you mentioned like the debt or the mortgage that the operator use for typically for multifamily or assisted living. There's hot loan. I know it's FHA sponsored loan. It comes with fixed interest rate and 35 amortization, which is great. But then there's also very high upfront cost, and it takes probably at least 12 to 18 months to get the loan to be approved. But typically they will work with you. So the chance of you getting rejected is actually pretty low, which is very good. But then you also mentioned the bridge loan. The bridge loan meaning that there will be varying interest rates. But then say for the single family world, for anyone who has already purchased their primary residence, they come with conventional loan with fixed interest rate for 15 or 30 years. Are there any loans like that available for this commercial?
You can still get fixed debt, like a regular agency debt for a traditional multifamily. You would just get normal agency debt and you could get it fixed. It just is high fixed, right? Like the rate goes up because you're getting it fixed. Every operator will probably use different debt based on their business plan. With assisted living, we know we're going into a HUD. We use very specific lenders that do bridge to HUD, meaning that they help us do every single thing to get into HUD. And the bridge debt is literally just to bridge us in. Yes, we're paying a higher interest for the first year, but it's interest only. And so that helps. And then after that, we transition and then we obviously drop our rate and then we're safe. As far as other assets, I was in another syndication for multifamily and they did 7 years fixed because they essentially were going to sell it 7 years. You can you can find loans like that. I mean, there's pretty much a loan for everything. They just all have different nuances, different LTV. We'll talk to a lender on that, but I'm a commercial agent, so I work with a lot of debt. You would definitely want to talk to a lender about that and they could let you know all the options, but they do exist for sure.
But I think that's good information for even passive investors to understand if the operator of the deal is over leveraging it, is having some way too aggressive assumption behind all those
100%.
numbers.
I think that's actually a really good point because I think what goes along with being a passive investor is they're busy. This is not their expertise. They basically just listen to whomever they're talking to, whether it be one of the GPs or whatever. They're kind of relying on them for their expertise, but like they have no idea what an LTV is. They don't know all these terms that like we all know because it's our expertise. I think that's important to ask that and understand that like, hey, how does the debt work? And take a deeper dive in that as a passive investor. But I also think that knowing who you're working with and you trust them and they're saying, hey, these are the reasons why we underwrote it this way. This is how we're buffering this. This is why it's so conservative. So our projections are basically, we hope to over deliver. And that's why these are just what we project, but they're still on the low end. And I think
Yeah.
that's what people need to do. I feel like there's so much competition that a lot of these operators think that they have to like just come out with these crazy returns, trying to win over these investors, like, oh no, I got the highest returns. But at the end of the day, like if they're underwriting too aggressively, then they're probably not going to hit those returns. So I would rather go for someone that has slightly lower, but I trust that they did it conservatively and they're most likely going to be higher because of that.
The other point that you touched on earlier, I think I would like to resurface it and point it out to the listener is finding an operator who is really vertically integrated. And as you mentioned, basically have the property management in-house and even have this like construction experience rather than having to leverage a third party, because all the variances can go wrong and cause a loss and kill the cash flow.
Yes. I mean, that's kind of my rule that like over the last 5 years, that is now what I suggest to investors, because you're just going to mitigate a lot more risk. If a third party is managing a property, you're a number. They don't care about your property for the most part. If your group and company is managing it, then they care. They're there every day. They're looking onto it. And so to me, as a passive investor, like that is reassuring. That's just like kind of my newer rule of thumb, because I've seen the difference in groups that, number one, are vertically integrated. They actually offer way better returns. They also are, I think, have less risk in general because of
Yeah.
that, and less expenses.
How do you see technology impacting the way investment are managed and properties are operated in multifamily
With
and assisted living?
multifamily, I know that there's a lot of technology that can be improved. I know they're rolling out a lot more stuff. I know they can do like tech packages with the cable and internet and stuff like that to kind of maximize some of the returns for investors. I know that they're starting to do like mobile leasing where people can just renew their lease online, so they can have like a little bit less employees with that. You can do all sorts of things, but I'm not as versed on the technology. As far as assisted living, obviously the technology comes into play a lot, because some of these properties that we acquire are going to be mom and pop, where they're actually still like having the paper files and charts, which is crazy with how much technology exists now. So we use technology a lot to digitize all of the medical charts, to be able to keep the staff just knowing what they're supposed to do, different checklists, medications. I mean, everything's like completely electronic, which just makes everything run a lot smoother for operations.
That's an immediate value add.
Yeah, huge. That's kind of been our focus now, is acquiring these facilities that are mom and pop. They're kind of struggling. And we can then go in from a business standpoint in operations and improve all these operations and step up the marketing, digitize everything. And we can create immediate value add to the point where it's pretty amazing. And that's kind of where we look.
Assisted living, as you mentioned, is basically a combination of business and real estate. When one wants to go in to purchase a business, you want to purchase something that is more like a mom and pop. They have operating it the old-fashioned way. They are not embracing all the new technologies into the system. And by you purchasing the business, then you can reinvent it by adding all this new technology into the business. That will just be a very easy value add. And that will be a good business like acquisition for anyone, right?
Oh yeah, absolutely. I think it's such an awesome investment. Just the demand, the fact that we can get lower interest, the fact that we can upgrade all of these operations from a business standpoint. We can offer really high cash on cash returns quarter one, which is pretty much unheard of from an LP standpoint, because I have a lot of friends that do multifamily, and very few can offer a preferred return right after closing. I mean, it is rare. There's some vertically integrated operators that do multifamily that can, but it's rare. It's not that common. So I find that to be a huge value.
But then with assisted living facilities, to me, when you purchase a facility, say the occupancy rate is pretty low, say 70%, then when you purchase these facilities, you basically have to reinvent the culture to make it working again. How do you assess that kind of situation?
Well,
Making sure.
every deal is different. The first one we purchased actually had a very high occupancy. It was like in the high 90s. Also, the two we're purchasing right now, they actually already have high. Some future ones that we're looking at don't have high occupancy. Those ones will just require a lot more marketing. Luckily, because we're vertically integrated and we have this portfolio now, we're able to start to create the demand, create wait lists in from our other facilities. And so we're able to filter those people into the new facilities that we acquire. So we kind of have this whole process where we already know how to fill them up before we buy them so that we're able to just get them set up pretty quickly. I think that just has to do with, again, scaling and having multiple facilities, having a large team, management, operators, employees, et cetera, that we're able to kind of grow them and expand them pretty quickly.
Plus, you already have a good brand locally,
Yes,
so that
and a
also
really good
helps.
brand.
What are some valuable lessons that you could share with listeners from investing in multifamily as well as assisted living?
I would say kind of just to reiterate all the same stuff almost, but get to know your operator, have a checklist of stuff that you want to go over with them, possibly talk to a passive investor that has invested with them before. So you have like a direct referral, find out if they're vertically integrated. And I would say do your own due diligence as well and give yourself a little bit of education on everything so you know how to kind of read a pro forma, how to read a deck, how to interpret it. So you're not just relying on the person that's explaining it to you. I feel like all those things would be things that I learned as a limited partner that helped me to kind of find better and better investments as I grew and became more educated about everything.
I have another question. How much communication do they typically provide to limited partners?
Like quarterly. So it'll be quarterly and it will literally go through what was the NOI for those 3 months? What were our projections? Did we hit them? Did we not hit them? Did we have any CapEx? I mean, it's very detailed with graphs and very spelled out. I love how we operate, how we communicate. I think it's really, really good. I would even ask for like, hey, can I get a sample of how you communicate, like one of your emails with everything? I've had investors ask that and I actually sent them and they were like super impressed. But that was a huge thing for them because they had done other LP investments where they were like every 6 months, 8 months, like giving like this terrible update. And they were just like, we don't even know what's going on. But usually it's because if they're not communicating, it's usually bad. And that's also scary. You got to be careful.
Sometimes even it's bad news, it's still good to communicate and to just communicate with the investor why we are not providing the kind of preferred like return we promised from the beginning.
People would appreciate, but instead I think they go silent because
That's
they
the
don't know
easy
what to
way.
do and they, want to let people down. And I'm sure there's all sorts of stress involved with it. But I think that becomes a lesson to limited partners that, okay, I know I want to be with someone that is going to communicate well.
I know you actually have a free ebook on assisted
Yes.
living that you can provide to the audiences. Would you share with us how our audiences can get in touch with you and learn about all different ways that you can help them to invest passively?
Yeah, absolutely. So honestly, the biggest platform that I'm like the most on is LinkedIn. It's just Megan Young. Nova Sky Capital is my company, and I'm sure you can link that for them so they can just click on it. I'm a little bit on Instagram, which my handle is Megan Young CEO. And then I'll also provide the link for my ebook, which is also on my LinkedIn. If they just click on my LinkedIn, it's featured. So they just have to click on it, download it, and that's ready to go. And I also have a investor checklist that we talked about that they could also download on my LinkedIn. And I believe my website as well is novaskycapital.com that we can also link. So there's some stuff on there, but honestly, LinkedIn is where I hang out.
Thank you Megan, for sharing your amazing journey and teaching us how we can invest passively and what kind of key point that we should look out for, and educating us on all these amazing different asset class that is available to people who wants to invest passively. I really appreciate your time, and it's such an honor to have you on the show.
Oh, thank you so much. I enjoyed being on here, and yeah, thank you so much.
Thank you.